Welcome to the deep dive. Today we are really tearing up the conventional financial playbook. If you've been watching the price of gold just soaring, hitting these historic highs, almost constantly, you've probably heard the usual explanation.
Oh, yeah. Inflation fears, maybe the Fed cutting rates soon, general market jitters.
Exactly. But that's what we're calling the noise today.
And based on our sources, it might even be, well, a deliberate misdirection, a story to keep you looking at the old reasons, the old ways things worked.
Right, so our mission in this deep dive is to cut through that noise and find the signal. Because this huge sustained buying of physical gold, it doesn't actually look defensive. It's not just hedging.
No, it feels, frankly, offensive.
Yeah.
Strategically offensive. It looks like a quiet financial world war being fought with gold bars, basically.
All setting the stage for a world that might not be centered around the US dollar anymore.
And look, if you're someone focused on your own strategic independence, building what we call your inner empire, getting this distinction right between the noise and the signal, that might be the single most vital cognitive shift you can make right now.
It lets you see the whole board, doesn't it? Instead of just reacting to the daily moves.
Absolutely. See the chessboard from above. Position yourself not just to, get through this change, but actually thrive in it.
Okay, so let's start by dismantling that official story. Why is it falling apart? The standard logic seems simple enough, right?
Yeah, the textbook stuff. One, gold's an inflation hedge. Prices go up, currency value goes down, gold should rise.
And two, interest rates. When real rates are high, like getting a safe 5% on a treasury bond, why hold gold? It doesn't pay yield, so high rates should hurt gold.
Correct. But the facts on the ground they don't fit anymore. The correlation seems broken or maybe even inverted.
How so?
Well, think back to 2022, 2023. We had absolutely massive inflation, right? Highest in decades in many places.
We certainly did.
In gold, it was pretty much flat, sometimes even down during those periods of peak inflation. But then, ironically, it starts this huge climb just as inflation begins to cool off. That's backward, according to the old rules.
That is a disconnect. But, gold's always volatile. Could that just be a temporary blip, some weird market timing thing?
It could be, except the interest rate picture makes the conventional story even harder to believe.
Ah, right, the second pillar.
Yeah. Real interest rates, the yield you get after inflation have been punishingly high for the last couple of years. By all traditional logic, gold should be incredibly unattractive in that environment. People should be flocking to bonds.
But instead...
Instead, gold blasts off to all-time highs. It's completely ignoring that headwind. It just doesn't seem to care about high real rates right now.
Okay, so if the two main drivers we always hear about inflation and rates are either broken or acting, upside down,
Yeah.
then what is driving this? What's the ghost in the machine pushing gold up?
And that's where the signal starts coming through loud and clear. The answer isn't hidden, really. It's right there in the data, especially from the World Gold Council.
Okay.
It's not your typical hedge funds making speculative bets. It's not everyday people rushing to buy coins that happens. The colossal, unseen force, it's the world's central banks.
Central banks. Okay, that is interesting. Why is that the critical piece here?
Because they are buying gold at a pace we haven't seen since 1967.
1967. Wow. Remind us, what's the significance of that timing?
That was just before the Bretton Woods system started to really fracture. The system set up after World War II, linking global currencies to the dollar, which was linked to gold.
So the last time central banks bought gold like this was right before a major global financial regime change.
That's the parallel. And the numbers are just staggering. In 2022, they bought a record 11,136 tons. A record.
1,136 tons.
Then in 2023, they followed up with another 1,037 tons. Huge numbers.
How much is that relative to, say, how much gold is mined each year?
Well, global mine production is usually around 3,000, maybe 3,500 tons a year. So these central banks, they're basically hoovering up something like a third of all the new gold coming out of the ground, year after year.
A third of global supply. That is immense demand. And these aren't day traders.
Not at all. Central banks think in decades, not quarters. They're accumulating physical metal, taking delivery, putting it in their vaults. This isn't a short-term trade. It screams structural shift.
And who are the main players here? Is it widespread?
It is pretty broad, but some stand out. The People's Bank of China has been buying consistently month after month for well over a year and a half now, but also Poland has been a huge buyer. Turkey, India, Singapore. Quite a few major players, particularly outside the sort of traditional Western G7 bloc.
Okay, so what is central bank buying on a historic scale? The why must be the crucial part then. What's their motive?
And it's probably not what most people think. They aren't buying gold hoping it goes up 10% next year so they can book a profit.
Right, they're not speculators.
They're buying gold because they seem to be systematically losing faith in the main asset they've been forced to hold for the last 50 years,
Legit.
the U.S. dollar, and U.S. Treasury bonds specifically.
So the dollar's role,
Hmm.
it's been more than just a currency since the early 70s.
Oh, absolutely. Since Nixon closed the gold window in '71, the dollar was basically been the central nervous system of global finance. Everything runs through it. Oil is priced in it. Trade is settled in it. Reserves are held in it.
But something shifted that perception dramatically.
Yes. In 2022, after Russia's invasion of Ukraine, the U.S. and its allies did something unprecedented. They weaponized that central nervous system.
You mean the freezing of Russia's foreign currency reserves?
Exactly. Nearly $300 billion worth, just frozen, gone, effectively, from Russia's control.
Wow.
That action, understandable as it might have been politically for the West, sent an absolute shockwave, really an existential tremor, through every capital city outside that Western alliance.
The message was?
The message was crystal clear. If your country falls out of political alignment with Washington, your nation's savings, held in dollars and dollar assets like treasuries, can be seized instantly.
So the asset, always considered risk-free, the U.S. Treasury bond, suddenly wasn't risk-free anymore.
Suddenly it carried massive political risk, counterparty risk based entirely on geopolitics. If the issuer can just decide not to pay you back or block your access, that changes the game entirely.
Okay, so if your national wealth, your reserves, can essentially be held hostage, you absolutely have to look for an alternative. A parallel system, maybe something that can't be controlled by one power block.
Precisely. And what asset fits that bill? What can't be easily censored, frozen, or confiscated digitally?
Physical gold.
Physical gold. It's the only major financial asset that isn't simultaneously someone else's promise to pay, someone else's liability.
Zero counterparty risk.
Zero counterparty risk. Its value is recognized everywhere, universally. Beijing, Moscow, Mumbai, London, doesn't matter, it's money.
So when these central banks are buying tons of gold,
they're not just diversifying. They are quite literally buying their monetary independence. They're laying the physical foundation for a new system, a new financial cathedral, brick by golden brick.
this really reframes the whole thing. It takes us back to that core idea. The price of gold isn't about looking backward at inflation that already happened.
Exactly. Stop thinking of gold as a mirror reflecting the past. Start seeing it as a forward-looking barometer.
The barometer of what?
Of de-dollarization, of the breakdown of the old system and the building of whatever comes next.
So the price isn't just a price. It's like the real-time construction cost of this emerging multipolar financial world.
That's a great way to put it, the construction cost of the new order. And you can actually see this tension playing out in the markets themselves. There's a growing disconnect between West and East.
How does that work? Where's the noise and where's the signal there?
Okay, so in the West, the focus is still largely on the noise. The paper markets. Think COMEX in New York, the London bullion market, the LBMA. Here, the price is heavily influenced by futures contracts, by ETFs, by derivatives. It's all based on expectations of inflation, rates, Fed moves.
And it's famously a fractional reserve system, right? There's way more paper gold traded than actual physical metal backing it up.
Massively so. The paper claims can be 50, 100, maybe even more times the amount of actual physical gold sitting in the vaults. So Western pricing reflects sentiment about paper claims.
Okay, that's the noise. So the signal is?
A signal is coming from the East, primarily the physical market. Think the Shanghai Gold Exchange, but also direct deals between central banks. These buyers aren't trading paper. They are demanding physical delivery. They want the actual bars, they're vaulting it, and they have zero intention of selling it back for dollars later.
They're taking physical supply off the market for good.
For good. And this relentless, massive physical demand from the East is starting to put serious strain on the paper promises of the West. It's starting to overwhelm that fractionally reserved supply. That's why the old models connecting gold only to Western inflation and rate expectations are breaking down. The physical demand is becoming the dominant force.
It sounds almost like history repeating itself, doesn't it? Didn't something similar happen before Bretton Woods collapsed?
It really does. The historical parallel is the run on U.S. gold reserves back in the 1960s.
Right. Countries started getting nervous about the U.S. printing too many dollars to fund, well, the Vietnam War and domestic programs.
Exactly. Countries, famously France under de Gaulle, started showing up and saying, okay, per the agreement, we'll take our gold now, please, at the official $35 an ounce.
And the U.S. couldn't keep up with the demand.
Eventually, no. That physical drain forced President Nixon's hand. In 1971, he temporarily suspended the dollar's convertibility to gold, close the gold window. That suspension is still in effect today, 50-plus years later. It ended Bretton Woods.
So what we're seeing now is like a decentralized version of that.
It really is a slow-motion, global, decentralized run on the dollar system. Instead of countries directly exchanging dollars for treasury gold, they're selling U.S. treasury bonds on the open market and using the proceeds to buy physical gold on the open market, mostly from London and Switzerland, and shipping it east.
It's a global vote of no confidence expressed through bullion flows instead of official requests.
Precisely. A methodical, strategic divestment from the dollar system into neutral physical reserves.
And this future system they're building often gets tagged with the BRICS plus label, right? Brazil, Russia, India, China, South Africa, plus new members like Saudi Arabia, Iran, UAE. Is the goal just to replace the dollar with, say, the Chinese yuan?
Not necessarily. I think it's more subtle, actually. The plus is key. It's a growing coalition of nations wanting options outside the dollar framework. It seems less about crowning a single new king, like the yuan, and more about achieving financial neutrality.
Neutrality. How would that work in practice? Trade still needs settling.
Right. They're pushing towards using their own local currencies for bilateral trade. So India buys oil from Russia in rupees or rubles. China trades with Brazil in yuan or real.
Okay, but that creates imbalances, right? If China sells way more to Brazil than it buys, Brazil ends up with a pile of yuan it might not want. How do they settle that difference without resorting back to dollars?
That's the trillion-dollar question, isn't it? What is the final neutral settlement asset that everyone trusts? An asset that doesn't give one country undue power over another.
And the candidate is gold.
Gold seems to be the consensus answer emerging. Think of it as the universally accepted receipt. If Brazil owes China, maybe the final settlement happens periodically by transferring gold between their central banks.
So gold acts as the ultimate reserve anchor, the bedrock for this multipolar, commodity-centric system they envision.
That appears to be the goal. To return the world, or at least a large part of it, to a state of financial neutrality underpinned by gold, where global finance can't be easily weaponized by a single dominant power.
Okay, this is a huge paradigm shift. So bringing it down to the individual,
Right.
what does this mean for you, the listener, for someone trying to build their own inner empire, their own resilience?
Right. And importantly, this is not a signal to panic buy gold tomorrow or bet the farm on it. That's reacting to noise again.
It's about being strategic, proportional,
Yeah.
forward-thinking.
Exactly. So maybe 3 core principles emerge from this analysis for the individual. First, the mindset shift.
Oh.
Stop thinking purely like a retail investor chasing short-term gains. Start thinking a bit more like, well, like a central banker.
Meaning?
View physical gold not primarily as an investment for upside, but as insurance. Insurance against the potential failure, or at least the serious malfunction, of the dominant financial system.
And adjust your time horizon accordingly.
Absolutely. Think in decades, not quarters or years. It's structural protection.
Okay, mindset shift. Gold as insurance, long-term thinking. What's second?
Second, embrace the principle of asymmetry. This is key.
Asymmetry, meaning a small input can have a large output.
Exactly. You likely don't need a huge allocation to gold to achieve the insurance effect. A modest, proportional amount of physical, fully owned gold, held safely, ideally outside the traditional banking system, provides potentially immense outsized protection if this de-dollarization trend continues or accelerates.
And the downside.
If the dollar system holds strong and gold doesn't do much, your loss on that small allocation is manageable, it's contained. But if things get rocky, that small allocation could become incredibly valuable, a real lifeline. That's asymmetry.
Got it. Small cost for potentially huge protection. And the third principle.
Third, practice jurisdictional agnosticism.
Meaning, don't put all your eggs in one country's basket.
Essentially, yes. Think about it. Having 100% of your life savings denominated in a single fiat currency, like the US dollar or the euro or whatever, that's actually a massive, concentrated, unhedged bet.
A bet that this time is different. That this empire, this currency, will last forever.
Right. And history is pretty clear that's usually not a winning bet in the very long run. Physical gold, held correctly, is perhaps the ultimate jurisdiction-agnostic asset.
It's recognized everywhere, not tied to one government's policies or stability.
Exactly. It's a first-class financial citizen in literally every country on Earth. It diversifies you away from the political and geopolitical risks inherent in any single fiat currency system.
So mindset shift, asymmetry, and jurisdictional agnosticism. That's a powerful framework.
It provides a strategic lens. And ultimately, it comes back to constantly distinguishing the signal from the noise.
The noise being.
The daily chatter, the cable news commentary, the Fed governor speeches, the minute-by-minute inflation data releases, the volatility in the paper gold markets.
And the signal.
The signal is the quiet, relentless physical movement of bullion, particularly from west to east. It's the quarterly reports from the World Gold Council tracking central bank buying. It's the community and actions coming out of these BRICS plus summits discussing dollar alternatives.
The few watch the signal. The many get lost in the noise.
That's the essence of it.
So, wrapping this up. The story of gold right now isn't just about markets. It feels like it's tapping into something much bigger.
It really is. It's arguably the central economic drama of this century so far. It's the story of global power rebalancing, of the slow, methodical construction of a potentially new world financial order.
And the key takeaway for you, the listener, seems to be about recognizing the pace of these changes.
Absolutely. These huge shifts, the decline of one empire's currency, the rise of another, like the transition from the British pound to the US dollar, they don't happen overnight. They are slow, tectonic, often century-long processes.
The mainstream news usually only covers them in hindsight, right? They report on the earthquake after the ground has already shifted.
Precisely. But by understanding this signal in the gold market, by seeing the script unfold, you, the listener, have the chance to not just be an observer reading about it later.
You can be a participant, positioning yourself thoughtfully, strategically, ahead of the curve, based on where the real flows, the real power dynamics seem to be heading, not just waiting for the history books to tell you what already happened.
And that really is the ultimate cognitive edge.